Now, one area that China Everbright is cautious about investing in is the property sector. And according to the South China Morning Post, the Chinese brokerage's CEO says a bubble is brewing in the mainland housing market. Now, our next guest says, relax. Overheating in China is just part of the process. And he's still bullish on China, along with the market of Indonesia. This morning, we welcome Teoh Kok Lin. He has outperformed the markets in 2009, making returns of over 77%, while the MSCI Asia Index has gained 35% in that period. And Kok Lin is the Chief Investment Officer of Singular Asset Management and joins us from Kuala Lumpur. Long time no see, Kok Lin. Thank you so much for joining us today. So you're joining these sentiments and you are still bullish on China. And in fact, you think the government's going to engineer a soft landing. But what do you hear when you hear talk of overheating in certain industries, bubbles forming possibly in the property sector?
Well, I think it's generally you have to look at China. The growth momentum overall is still quite strong. Even though there are certain area of bubble forming in main city like Shanghai, Beijing in properties, but really if you speak to the developer there, I don't think you're going to see a crash there because a lot of purchases of this property are using hard cash. We're not really using bank lending. Beside the fact that there's still a lot of pent-out demand. If you look at the whole China, the basic demand, especially in the rural areas, there's still basic demand for the refrigerator, TV. So the growth story of China is still very much at the beginning stage.
Yeah, well, where else are you going to look for growth these days? Because a lot of people, including yourself, say forget about that recovery in developed markets like the U.S., Europe, and Japan. In fact, the recovery might not be there and it might be strong enough for another 2 to 3 years.
I think certainly if you look at what's happening in the West, Europe, US as well, the growth is going to be quite slow and anemic. What it means also is that interest rate there going to remain quite low. It's going to encourage a lot of fund flow, growth momentum in the area like China, India, Indonesia. I think that's where you continue. And if you just go and visit a lot of factories in China today, many of them are running at full capacity. They are short of workers. It's quite a big difference from, say, a year ago.
Yeah, and Kok Lin, why don't you talk to me about allocation at this point? How much are you putting into Chinese stocks? How much are you putting into Indonesia? Or how much are you holding in cash at this point? We're holding probably about 10% cash, but with about 30% in China, mainly through the 8 shares in Hong Kong and selective stock in Singapore, 20+% in Indonesia. Again, we still have about 20% in Malaysia, where we know the market quite well. Then the balance of 20% are largely in Singapore. Okay. Well, Kok Lin, we're going to go to commercial break at this point, but when we come back, I want to get into your stock picks and some interesting plays, mostly on the Chinese consumer and also infrastructure in Southeast Asia. And we're talking to Teoh Kok Lin, who's the Chief Investment Officer of Singular Asset Management, where he has returned 77% to his clients over the past year. Also coming up on the edge, is there a best or worst month to buy into gold? Apparently there is. We'll take a look at gold's historical performance and tell you just when exactly to expect this sell-off. Stay with us. Okay, well, there is one country that may not be buying up the IMF's bullion, the gold at the IMF these days, and that's China. Surprise, surprise. The World Gold Council says that China isn't a, quote, realistic candidate, given the fact that it is the world's largest producer. I didn't know that. Now, the IMF privately sold more than 200 metric tons of bullion to the likes of India, Mauritius, and Sri Lanka's central banks last year, and says that it plans to expand sales soon to the open market. Now, let's get back to our guest for the second half of the program, who's also quite bullish on China these days. We're talking to Teoh Kok Lin, who's the Chief Investment Officer at Singular Asset Management, where he has helped return 77% gains to his clients over the past year. And he rejoins us from our Kuala Lumpur studios. Okay, Kok Lin, let's talk about your exposure to China, because you get it through those 8 shares, those Chinese companies listed here in Hong Kong. And interestingly enough, B shares on the mainland, is that right? Aren't these B shares pretty much going extinct at this point and going to be merged with A shares?
Largely it's 8 shares. B share we're exploring, but the liquidity is a bit a challenge.
Yeah, B shares.
So largely still very much invested in the 8 shares, as well as the
Yeah,
they
B
are
share is
pretty
been
much
illiquid.
illiquid.
No, you're constantly waiting for the
the merger.
Yeah.
Okay, so let's talk about that specific name, Kok Lin, because you're also advocating playing on the Chinese consumer, the rising influence on the mainland, and the stock that you recommend to do this is Heng De, which is the Hong Kong watch distributor. In fact, the stock has pretty much soared in the past 12 months, close to tripling, up over 230%. Now, where do you see this stock going? Because our analysts are saying maybe 16% more gains from here. Are you more optimistic than that?
I think certainly so. I think the company is one of the largest high-end watch distributor in China with market share of more than 30+%. If you understand, you look at the Chinese rising affluent, I think the earnings growth can easily grow by 20-25% for the next 2 or 3 years, compounded per se as well. So easily on a 2 years view, you can easily see a 50% increase in the share price.
Yeah, it does have very healthy numbers. For instance, a return on equity looking at 24%, gross margins at 24%. But Kok Lin, when you look at this correction that we're seeing in the H shares, with valuations trading at maybe 12 to 13 times for PEs on average, maybe Heng De might be looking a little bit pricey. There might be better bargains out there.
Yeah, perhaps, but I think it is one of those companies whereby the quality of growth is a lot better, good management teams, and and there are a lot less competitions because they have a dominant market shares, and with the rich Chinese love to have high-end watches, and therefore I think the quality of earnings is a lot more important, and that slightly higher multiple reflect that kind of high quality growth.
Okay, Kok Lin, let's quickly talk about your other, you can say, Chinese consumer play, which is Hongliang Asia. In fact, this owns the second largest refrigerator maker in China at this point. Looking at $3.5 Sing dollars at this point, but analysts also have huge expectations on this stock, looking at upside of 48% from here. Do you agree with the optimism?
Yeah, I think the company is quite undervalued they are the second largest refrigerators, distributors maker in China, and that a lot of government subsidy program try to encourage more electrification or electric goods products in rural China. So the growth tremendous is quite good. The stock is very undervalued because it is listed in Singapore, and most people focus on the Shanghai, the Hong Kong listed, whereas this is listed in Singapore, extremely well managed by the Hong Leong Group as well. So certainly, if you compare with many of the major A-share listed companies, this is quite undervalued.
Yeah, and it's up 600%, I believe, just in the past year. Okay, Kok Lin, thank you so much for joining us today. That's Teoh Kok Lin of Singular Asset joining us from KL.